If you have spent any time researching how to invest, you have almost certainly come across two terms, ETF and mutual fund, used in ways that suggest they are either the same thing or completely different things depending on who is writing about them. Most explanations make this comparison more complicated than it needs to be. They lead with trading mechanics, creation units, and net asset values, language that sends most beginners straight to another tab. So let's try a different approach. Here is the real story. ETFs and mutual funds are both containers. They both hold a collection of investments, stocks, bonds, or both, inside a single fund. When you buy one, you are buying a slice of everything the container holds simultaneously. That core function is identical. What is different is how those containers work, and some of those differences, particularly around cost and taxes, quietly cost investors thousands of dollars over decades without them ever realizing it. By the end of this video, you will know exactly what separates these two investment types, which one is better in which situation, and precisely which one most people should be using for most of their investing. We are going to cover how each one works, the real cost difference in actual dollars, the tax difference that most people completely overlook, who each one is actually designed for, and a clear answer on which to choose based on your situation. This is wealth clarity. Let's get into it. Let's start with the mechanics, kept as simple as possible. A mutual fund pools money from thousands of investors to buy a collection of stocks, bonds, or other assets. When you invest in a mutual fund, you send your money to the fund company, Fidelity, Vanguard, Schwab, and they handle everything. At the end of each trading day, all the fund's holdings are valued together and a price is set. That price is called the net asset value. When you buy or sell a mutual fund, you do so at that single daily price, whatever the market closed at. An ETF, which stands for Exchange Traded Fund, works similarly in terms of what it holds. The difference is in how you buy and borrows and sell it. An ETF trades on a stock exchange, exactly like a share of Apple or Amazon. Its price fluctuates throughout the trading day based on supply and demand. You can buy it at 9 in the morning, sell it at 2 in the afternoon, and the price will likely be different each time. For a long-term investor who buys and holds for decades, which is the strategy most financial experts recommend, this difference in trading mechanics is largely irrelevant. You are not trying to catch a specific price during the day. You are buying and holding. Whether you transact at a daily closing price or at a real-time price does not materially affect your outcome over 20 or 30 years. Where the differences do matter, significantly, is in cost and in taxes. Both ETFs and mutual funds charge an annual fee called an expense ratio. This is the percentage of your investment that the fund takes each year to cover its operating costs. It sounds small. The compounding impact of it over decades is not small at all. The average expense ratio for an actively managed mutual fund in 2026 is approximately 0.66%. Index mutual funds are considerably cheaper, often 0.1 to 0.2%. ETFs that track an index, which is the category most relevant to individual investors, typically charge between 0.03 and 0.2%. Fidelity's FZROX charges literally zero. Here is what that difference looks like in real money over time. Suppose you invest $10,000 and earn a 6% annual return before fees. With an ET charging a 0.05% expense ratio, your net return is 5.95%. After 30 years, your $10,000 grows to approximately $56,000. With a mutual fund charging 0.75%, your net return is 5.25%. After 30 years, your $10,000 grows to approximately $44,000. Same initial investment. Same underlying market return. A $12,000 difference from fees alone. And that is on a $10,000 investment. Scale that to $100,000, and the gap becomes $120,000. This is why fee awareness matters. A 0.30 percentage point difference in expense ratio can mean tens of thousands of dollars over 30 years. And most people choosing between funds never look at the expense ratio at all. It is worth noting that expense ratios have been falling for both ETFs and mutual funds over the past decade as competition has intensified. But the gap between actively managed mutual funds and low-cost index ETFs remains substantial. The cheapest ETFs are still significantly cheaper than the average actively managed mutual fund. And as we discussed in an earlier video, actively managed funds underperform simple index funds over a 10-year period in roughly 95% of cases. The second major difference between ETFs and mutual funds is tax efficiency. And this is the one that surprises almost everyone who learns about it for the first time. When you invest in a mutual fund, the fund manager buys and sells securities inside the fund throughout the year, rebalancing, responding to redemptions from other investors, pursuing their investment strategy. Every time the fund sells a security at a profit inside the fund, that profit is a capital gain. And mutual funds are legally required to pass those capital gains on to investors as annual distributions, even if you personally did not sell a single share. This means you can hold a mutual fund all year, never sell, never touch it, and still receive a capital gains distribution in December that you owe tax on. Taxes on gains you did not personally realize, from transactions you did not make, in a year when your own investment may have actually lost value. In 2025, 52% of mutual funds distributed capital gains to investors. 52%. That means more than half of mutual fund investors received an unexpected tax bill or had their tax-advantaged space consumed from activity they had no control over. ETFs handle this completely differently. Because of a structural mechanism called the in-kind creation and redemption process, which you do not need to understand fully, ETFs are able to manage institutional investor redemptions without triggering taxable capital gains events inside the fund. The result is that in 2025, only 7% of ETFs distributed capital gains. 7% versus 52%. For investors holding funds in taxable brokerage accounts, this difference is significant and compounds every year. The tax you pay on mutual fund distributions is money that leaves your account and stops compounding. In an ETF, that same money stays invested, continues growing, and is only taxed when you personally choose to sell. There is one important exception. Inside a tax-advantaged account, a Roth IRA, a traditional IRA, a 401k, capital gains distributions from mutual funds do not trigger an immediate tax bill. The tax efficiency advantage of ETFs over mutual funds largely disappears inside retirement accounts. If all of your investing happens in tax-advantaged accounts, the tax argument for ETFs versus mutual funds matters considerably less. With the cost and tax differences clear, here is who each investment vehicle is genuinely suited for. Mutual funds, specifically low-cost index mutual funds like Fidelity's FZRX or Vanguard's VTSX, are ideal in two specific situations. The first is automatic investing inside a retirement account. Most 401k plans allow you to set up automatic payroll contributions that go directly into a mutual fund on every payday. This dollar-cost averaging into a mutual fund is seamless and does not require you to do anything after the initial setup. ETFs, because they trade like stocks, require you to place individual buy orders, which is a small friction point that matters when you want the process to be completely effortless. The second situation is when minimum investment amounts are not a concern and you want simplicity above all else. Some investors prefer mutual funds simply because there is no bid-ask spread to worry about and no intraday price fluctuation to observe. ETFs are ideal in two different situations. The first is a taxable brokerage account, where the tax efficiency advantage directly reduces your annual tax bill. The second is when you want maximum flexibility, including the ability to buy as little as $1 through fractional shares, access to the widest possible range of investment options, and the ability to trade at any point during market hours if your situation ever requires it. For most beginner investors opening a Roth IRA or taxable brokerage account at Fidelity, Schwab, or Vanguard in 2026, an index ETF like VOO or VTI is the better starting point, primarily because of lower expense ratios and better tax efficiency in taxable accounts. Inside a workplace 401k where your choices are limited to the fund menu provided by your employer, you will often end up in mutual funds regardless, in which case choose the lowest expense ratio option available. Here is the decision simplified into 3 questions. Question 1. Are you investing inside a 401k? If yes, choose the lowest expense ratio mutual fund available in your plan's menu. The tax efficiency argument for ETFs does not apply inside a 401k, and mutual funds are easier to automate through payroll. Question 2. Are you investing in a taxable brokerage account? If yes, choose an index ETF over a mutual fund where possible. The tax efficiency difference is real and compounds annually in your favor. Question 3. Are you investing in a Roth IRA or traditional IRA? Either can work well here. Low-cost index mutual funds and index ETFs are both excellent choices inside a retirement account. Choose based on which you find simpler to manage. If your brokerage offers both and their costs are similar, ETFs have a slight edge from tax efficiency even inside IRAs in some scenarios. But the difference is smaller than in a taxable account. The most important decision is not ETF versus mutual fund. It is low-cost index fund versus high-cost actively managed fund. A low-cost mutual fund beats a high-cost ETF every time. Get the fees right first. Then optimize for tax efficiency second. Here is everything we covered today. ETFs and mutual funds are both investment containers that hold a collection of assets. The core function is the same. The differences are in trading mechanics, cost, and tax efficiency. Cost. Index ETFs are typically cheaper than actively managed mutual funds. A 0.7% fee difference costs you over $12,000 on a $10,000 investment over 30 years. Tax. Only 7% of ETFs distributed capital gains in 2025 versus 52% of mutual funds. In a taxable account, this makes ETFs significantly more tax efficient. In a retirement account, the difference shrinks considerably. Who should use what? ETFs for taxable brokerage accounts and IRAs. Low-cost index mutual funds for 401k plans where automatic payroll contributions make them easier to manage. And the most important rule of all, whatever you choose, choose the lowest cost version available. Fees are the one variable in investing that you can control completely, and controlling them is worth far more than any other optimization you will ever make. If this gave you a clearer picture of what you are actually buying when you invest, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube is going to show you the perfect next video right on your screen. I will see you there.